Despite new gains in the stock market, the family offices of high net worth investors are increasingly pouring their money into alternatives, and real estate is high on their list. But for some, instead of going it alone, they're joining forces. The multifamily office model lets them pool resources, share expertise, and unlock bigger deals. With more than $12 billion under management, Realm is a multifamily office investment platform specializing in commercial real estate. I sat down with CEO Travis King to ask what sets his strategy apart and where he sees the next big opportunities. Family office is one thing, but you are in the multifamily office business. First of all, explain what that is, what that means.
A family office is typically a family that's got significant net worth to the extent that they want to actually have a lot of their own investment infrastructure in-house, right? That's typically for a single family office, which does it by themselves. That tends to be kind of $100 million is kind of the starting point where that starts to make economic sense. Our typical family has about $200 million on investable assets on average. We're combining not only capital, but also our collective trusted relationships and industry knowledge and geographic knowledge to find and execute better investment decisions. So each of those families could build out their own infrastructure. We built our wealth over the last 20 years investing in real estate. We've got a large staff of people all across the country investing across property type and geography, doing a lot of transaction volume, and it allows us to be focused on that, doing it, uniting our resources than any one group that just decides to do it individually. That's really the benefit.
And why in real estate? What is the next great real estate play?
Real estate is evolving, right? There's never one thing that you want to be focused on in real estate. And I think that's part of what gives us a leg up in the fact that most of real estate, you've heard the adage, location, 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 and that's true. I think that continues to be a very true adage. What we find is that we're unique, that we move across property type and across geography. Given the scale that we have as an organization, north of $12 billion of investable assets, right, amongst these families that we work with, we have the ability to see a lot of different deal flow in a lot of different areas. And what happens is in real estate, there's a macro cycle, and that cycle is always very important. You don't want to swim against the tide. You also don't want to, try to fight the cycle. But there's micro cycles that happen in different geographies and within different property types. So that's a key thing to consider. You want to be, at the right place at the right time. And we find that location matters, but you want to be in the location at the right time for the right time in the cycle as well. That's what we do, is spend a lot of time really trying to compare and contrast what our options are all across the country to look at the best risk-adjusted returns given what's going on in the macro environment.
You've got to have a fave, right?
For sure. So if you look at this point in time, what we think is interesting, you'll start with office. I think in a lot of areas, we're starting to see office really be in an area where we think that pricing has kind of bottomed. In some cases, we're buying things at 15% of replacement cost. But what you have to be right about is whether that particular office building is still viable. And if that's still going to be a property that wants to be leased, if people are going to come back to the office, because there's a narrative, and I think it's a valid narrative that, hey, there's a new world in which we live, which a lot of people work from home. We have to make sure that we understand how does that change going forward. And that's about the supply and demand of these buildings. And do we have too much, too little? Which ones are the right ones? So undeniably, that becomes more of the decision is, are you picking the right properties? And if you pick the right properties, I think the pricing is out there now. So you still have to choose wisely. But I think that's a real theme. Some of these, it's amazing how inexpensive some of these properties are for very high quality properties that are really well located and I think still very functional.
But what's telling you that office has finally bottomed? Because there's still a lot of risk in that sector.
Couple data points. I think that if you look at, New York's a great, I think, canary in the coal mine. If you look at office swipes and attendance in office now, it's basically even recovered and is ahead of where it was pre-pandemic back in 2019. Miami's similar in that regard. Some areas are still catching up for sure. I think Denver's still, way off. But there's certain areas that we look at, like in Northern California, where you've got a strong ecosystem of technology that exists there, where you look at it and say there's such embedded infrastructure and such a strong ecosystem of professionals and information and all the things that make business possible. We think that those are areas where you look at it and say it's hard to imagine a world where those things just aren't going to exist anymore. Supply might drop and demand is going to fluctuate, but I don't think it evaporates.
So what are you staying away from? I mean, everybody's in data centers right now. The kind of industrial play seems like it's over because e-commerce isn't as hot as it used to be.
What I try to stay away from are broad categories. I think the market by and large does just what you said. They look at things and say, okay, data centers, they've been overinvested, and now there's too much capital in data centers. We particularly were not really in data centers in a large way because we focused on that lower middle market.
Everybody's in data centers.
Yeah, but it's the big boys in data centers, right? I'm trying to find an angle where we have something that others don't. We really focus on kind of $50 million deals and below because we feel like we've got an edge there.
So there's a new report out. The number of family offices with investments in alternatives, that includes real estate, is up over 500% in the last 10 years.
Yeah.
Do you see that from your clients? Do you see that going forward?
100%. I think if you look, there's been a strong shift, I think, over the years of the traditional wirehouses where people were looking at traditional stock and bond portfolios, right? And I think what's happened is obviously the last run of over the last 20 years of private equity has been a big boon to that, right? A lot of the institutions that went into that early on, some of the pension funds and endowments have achieved great returns. Again, it ebbs and flows, but by and large, private equity's had a great run. Real estate's been very similar as well, right? You've had the institutionalization of real estate. Allocations to real estate have grown significantly. But what I think you're starting to see now are institutions have basically now had significant allocations to private equity and real estate, which are kind of considered alternatives. What I think you're seeing now is the rise of the high net worth investor in that.
And you said before that you tend to stay in the middle market. Why do you do that? Why not go bigger? They say go big or go home, right?
Yep. No, it's a great question. I think my team will ask me that all the time because a lot of times the adage will be it takes the same amount of work to do any size transaction. And if you're doing smaller deals, you're working a lot harder for putting out less dollars. We try to be very intentional about staying in our lane. If you have the largest amount of capital, there's deals that are open to you that otherwise might not have been available to most people. But that happens at the other end of the spectrum too, where if I'm going to get paid to win basketball games, I'd rather play, against the third graders on the playground than to play against an NBA team. So that's really how we look at it. Our job is to get the best risk-adjusted returns we can for our capital. And we find that it's more abundant in the lower middle market, right? We find that there's more abundant deal flow. There's less sophistication, and there's more opportunity to find those edges that we're looking for when we invest.
How does your business change if interest rates come down?
Well, I would say reducing interest rates helps real estate in most every regard, right? I think first and foremost, it's going to help transaction volume. I think it just provides a win to the sales of transactions. And it raises the value of all real estate, right? We saw that when we had really, really low interest rates. You saw the rapid increase in resulting values. So I think a drop in rates would be a very large boon to the real estate business as a whole, for sure.